What's up with all the hysteria? There's bloodshed, there's fear. What's going on? The markets are tanking. People are losing money. People are losing their minds. What's going on? Why is this taking place? Let's all settle down. Let's calm down and reevaluate what's causing the markets to sell off. Maybe you could find a logical explanation, and maybe you could find a way to make money in this trade. So what's up, you guys? My name is Boris Portnov. I'm an investor. I like to invest with. I'm a real estate investor. I like to dabble in the stock market, and I love everything having to do with finance. Late February, early March 2020 was the inception of COVID into our society. The markets tanked and they bottomed out around March. Since March 2020 till at this point, we're coming up on the 12th month anniversary of the inception of COVID. We're looking at coming into the end of February, early March 2021. And for the past 12 months, we've seen the stock market go nearly vertical. A lot of people have made great returns on their investments. But now the markets are selling off. We're seeing a lot of red in our screen. So what's taking place? Don't get hysterical. Let's take a step back. Take a look at the greater picture to fully understand why this is happening, and make your response reactionary to what's happening. All right? So why are the markets selling off? It's because of fear of inflation. Why are we fearful of inflation? Well, take a look at the market. The market is at all-time highs, yet the economy is still in terrible shape. A lot of people feel that equities are inflated. Equities are way too high. In addition to the amount of margins people are utilizing, a lot of retail investors up to the margin like this, and at the moment we have a sell-off, they're going to be like this, and they're going to be drowning. They're going to get margin calls. So a lot of people are coming to the realization that equities are inflated. They're a little bit too expensive. So a lot of people are selling their equities, they're selling their stock market positions. And where are they running to? They're running to treasuries, the bond market. That's what you see right now is the bonds, the treasuries, the yields on the bonds are increasing. So basically, to fully understand treasuries, let's go ahead and give you an explanation. Let's say, for instance, I'm selling you this note. The U.S. government funds their day-to-day operations by selling treasuries. That's how they finance their operations. So let's say, for instance, I'm the U.S. government and I'm offering you this treasury note. Who wants to buy this treasury note? I'm willing to pay $20 interest annually on this treasury note. If this note is selling for $2,000 today, I'm paying $20 interest to you. You're going to collect 1% interest on this treasury note. However, no price stays stagnant. As we understand supply and demand, there's more people walking into the treasury bond markets to purchase treasuries. So when there's more buyers, there's downward pressure on the price of treasuries. So let's say this treasury note is no longer worth $2,000. It's now worth $1,000. However, I'm still going to pay you $20. I'm still going to pay you $20 on this note. So the yield goes from 1% to 2%. Still paying you $20, but when the note is worth $1,000 as opposed to $2,000, now the yield is 2% as opposed to 1%. So the yields, as more people are stepping into the treasury bonds market and purchasing treasuries, the prices are going down, the yields are going up. People are taking notice of this. People saying, wow, this is becoming a more attractive investment, and it's a less risky investment as opposed to being fully invested in the stock market. So people are selling their equities and they're running over to a safe haven investment. They're running to the treasury bond market. The maturity bond, if you look at the yields on the 10-year treasuries, you'll see they're coming up to 1.5% interest. This is 1.5% interest is a point where a lot of people start getting interested in treasuries. So we're coming up on that 1.5% interest rate. So that's what's going on with treasuries. A lot of people are dumping their stocks and running into treasuries. There's also additional inflation fears. We have a $1.9 trillion stimulus package on the verge of being signed by Congress. There's a lot of liquidity being dumped into the market. There's more money being deposited into people's bank accounts. However, people aren't able to spend that money because they're locked up. They're shackled up in their house with the ball and chain. They can't leave their house. So what we have is inflationary fears, because once the economy fully reopens, people are going to go out and shop. So we've vaccinated about 11% of the U.S. population. About 11% of the U.S. population has, at this point, received at least the first dose of a COVID vaccine. So we're trending in the right direction. It's undoubtedly our economy is going to reopen. People are still shopping today, but they're shopping virtually. They're doing mail order deliveries, Amazon. That's why Shopify, Amazon. You see Zoom, all these online Stocks are doing well, but the brick and mortars, Macy's, JCPenney, they're struggling. So once the economy reopens, people are going to go shop. So when people go shopping, people are fearful. A lot of discretionary spending is going to flood the markets, and people are scared of inflation. One other thing that's causing the markets to sell off is the Fed. People are fearful the Fed is going to increase rates sooner than they've promised. The Fed tracks inflation. Their target is 2%. Should inflation increase faster than 2% annually, they may start increasing their interest rate to combat inflation. They may stop buying treasury bonds. They're buying treasury bonds to inject the markets with liquidity. They're keeping interest rates low to stimulate growth, to stimulate lending. So should interest rates start, should inflation rates, should the pace of inflation outpace 2%, they may start increasing interest rates, or they may taper down their bond purchases to counteract this inflation. So people are fearful that the Fed will become less dovish. Dovish meaning they're very accommodating to the market. They're doing whatever they can to cushion this market. People are fearful that the Fed is going to retract from their current policy and become less dovish. But the Fed has time and time again stated that they will remain on track to remain dovish. They are not fearful of inflation currently. They track consumer spending, and they don't see inflation right now. So let's jump into some more market analysis to really dive deeper into our understanding of this market. If you guys take a look at this chart of the 10-year U.S. Treasury, you'll see that we bottomed out this is a chart of the yield. You'll see that we bottomed out in around April, we bottomed out in terms of the Treasury yield. We were trading about 0.6, 0.7%. And then we started spiking up here. We started spiking up in January. February, we saw a big rapid spike and increase in the yield. We're coming up to that 1.5% threshold. That 1.5% is the point at which people start taking notice of Treasuries. Say, hey, I'm getting a better return on my investment if I jump into Treasuries. And that's one of the reasons why people are fleeing the stock market and jumping into Treasuries. This is the S&P futures markets. So as you can see, we tagged the low back in March. We tagged the low of 2174 back in March, basically the inception of COVID when the markets bottomed out. And since that point, we've been nearly vertical, straight up, and away rocket ships. So we topped out in the futures markets around mid-February. Our highs were 39.59 and a quarter. So since that point, we've been dropping, right? But this is a valid trend line. As you can see, we've been holding the trend line here. We tagged the trend line once. We tagged it twice, right? We're still in the uptrend. I can't say we've broken this trend. So at this point in the futures market, in the S&P 500, we are still trending upward in the right direction. Now, every time we've touched this trend line, it's been a good trade. It's been a long trade, right? Anytime you touch an upward trend line, the trend is up. Trend is up. The trend is up. And there's money to be made every time you tag a trend line. As you can tell, the distance between one time you tag it to the next time is long, then it's gotten shorter, and then it's gotten shorter. But we're about to tag the trend line again. So I would say that unless we trade below the trend line, the market still remains bullish. Now, what I drew here on the right side of the screen is called a Fibonacci retracement. These are basically retracement levels that are really common in which we tag a certain level and then you retrace and you go back up. So on the Fib retracement, we're coming up to 61.8. 61.8% is a very popular Fibonacci retracement. Oftentimes we tag this number and we turn around and go right back up. So we're coming down to the Fib retracement, 61.8, and coincidentally, the 61.8 Fib retracement is also right there tagging our trend line. So that's another confirmation that we're going to come down to this level and we may turn around and retrace and head right back up. That's technically how I analyze the direction of the market. Now, if we trade below 61.8, we trade below that trend line, I'm going to say right now, look out below. These markets might not be so favorable going forward. But until that point, I'm just going to react accordingly. I trade according to the charts, all right? So am I now bearish on the U.S. economy? Absolutely not. On the contrary, I remain bullish on the U.S. economy. The Fed has pledged to keep interest rates low through 2024, which will continue to stimulate the real estate market through mortgage rates, low mortgage rates. Additionally, they're very dovish. They're injecting the markets with lots of liquidity with buying treasury bonds. There's lots of liquidity, rates are low, the Fed is dovish. Never fight the Fed. Trading against the Fed is like swimming upstream. You're going to do a lot of work, but you aren't going to get anywhere. Never trade against the Fed. I'm very bullish on the economy. However, I'm not going to continue to own all those high growth stocks, those big tech stocks that I've owned the last 12 months. There's now a sector rotation taking place. People are selling their Teslas, they're selling those nano dimensions, they're selling all those speculative SPACs, and they're now transitioning into value plays. The consumer staple stocks, their Budweisers, their Procter & Gamble's, their Walmarts, their CVS's and Walmarts, I mentioned that, right? That's where people are transitioning into consumer staples. That's where the play is going forward. So I'm not selling. I'm just transitioning, you guys.
I never seen anybody do the things you